Hello and welcome again. This is your host Harshit Simha, continuing the series by taking lead from the previous week's topic on global reporting initiatives, and now today, we explore a transformative development in global corporate reporting, the emergence of the International Sustainability Standards Board under the IFRS Foundation. This opening slide introduces the International Sustainability Standards Board as a landmark development in the evolution of global corporate reporting. Established under the IFRS Foundation, the ISSB is designed to deliver a comprehensive and globally consistent framework for sustainability-related financial disclosures. At its core lie two foundational standards, IFRS S1 and IFRS S2, which collectively integrate sustainability considerations into mainstream financial reporting. The emphasis on a global baseline is particularly significant. Historically, sustainability reporting has been fragmented across multiple frameworks, leading to inconsistencies, reduced comparability, and increased reporting burdens. The ISSB addresses these inefficiencies by offering a unified structure that aligns sustainability disclosures directly with investor needs and capital market expectations. From a strategic perspective, this framework marks a paradigm shift. Sustainability is no longer treated as a peripheral or voluntary disclosure but is embedded within the enterprise value narrative. Organizations are now expected to articulate how environmental and social risks and opportunities influence their financial position, performance, and future prospects. For practitioners and stakeholders, this slide sets the tone for understanding ISSB not merely as a reporting standard but as a governance and decision support mechanism. It signals the convergence of sustainability and financial reporting into a single, cohesive language, one that enhances transparency, strengthens investor confidence, and facilitates more efficient capital allocation across global markets. Slide 2. ISSB at a glance. This slide provides a concise yet powerful overview of the ISSB framework, highlighting its global relevance and institutional credibility. The ISSB operates under the governance of the IFRS Foundation, ensuring alignment with internationally recognized financial reporting principles. The International Sustainability Standards Board was constituted to formulate a coherent and globally consistent baseline for sustainability-related financial disclosures. Functioning under the auspices of the IFRS Foundation, it is strategically designed to serve the information requirements of investors and capital market participants across international jurisdictions. The issuance of two core standards, IFRS S1 and IFRS S2 in June 2023 represents a pivotal milestone in standardizing sustainability disclosures worldwide. The statistic indicating engagement across 140+ jurisdictions underscores the rapid global traction and acceptance of ISSB standards. This widespread adoption reflects a growing consensus among regulators, investors, and corporations regarding the necessity of consistent and comparable sustainability information. From a professional standpoint, this slide emphasizes the credibility and scalability of the ISSB framework. Unlike fragmented regional approaches, ISSB offers a harmonized model that can be adopted, adapted, or integrated into national regulatory systems. This flexibility enhances its applicability across diverse economic contexts, including developed and emerging markets. Moreover, the slide reinforces the ISSB's strategic objective: to create disclosures that are decision-useful for investors. By focusing on financial materiality, the framework ensures that sustainability information is directly linked to enterprise value and capital allocation decisions. In essence, this overview positions ISSB as a global standard-setting authority capable of bridging gaps between sustainability and financial reporting. It provides stakeholders with a clear understanding of the framework's scope, legitimacy, and transformative potential in shaping the future of corporate transparency and accountability. Slide 3. Why a global baseline matters. This slide articulates the fundamental rationale behind establishing a global baseline for sustainability disclosures. The ISSB framework addresses three critical dimensions, which are essential for effective capital market functioning. 1. Consistency ensures that organizations across jurisdictions adhere to a unified set of reporting principles, thereby reducing fragmentation and eliminating the confusion associated with multiple overlapping frameworks. For multinational corporations, this translates into reduced compliance complexity and improved efficiency in reporting processes. 2. Comparability is equally vital from an investor's perspective. Standardized disclosures enable stakeholders to evaluate sustainability performance across companies, sectors, and geographies with greater precision. This enhances the quality of investment decisions and supports the allocation of capital toward more sustainable and resilient business models. 3. Reliability, the third pillar, underscores the importance of credible and verifiable information. ISSB standards are designed to ensure that disclosures are not merely narrative but are grounded in robust methodologies, metrics, and governance structures. This strengthens trust among investors and other stakeholders. From a strategic viewpoint, the establishment of a global baseline represents a shift toward integrated reporting ecosystems, where sustainability is seamlessly embedded within financial disclosures. It reflects a broader movement toward transparency, accountability, and long-term value creation. Ultimately, this slide conveys that the ISSB framework is not just a regulatory development but a market-driven necessity, enabling more informed decision-making and fostering a more sustainable global economy. Slide 4. Investor-focused design. This slide highlights the defining characteristic of the ISSB framework, its explicit focus on investors and capital market participants. Unlike broader sustainability initiatives that address multiple stakeholder groups, ISSB standards are designed to deliver decision-useful information that directly influences investment and financing decisions. The framework is structured around two core pillars: IFRS S1, which establishes general requirements for sustainability-related financial disclosures. From a professional perspective, this investor-centric approach enhances the relevance and applicability of disclosures. By focusing on financial materiality, ISSB ensures that only those sustainability factors that have a tangible impact on enterprise value are reported. This avoids information overload and ensures clarity for users of financial statements. Furthermore, the alignment with capital market expectations strengthens the credibility of disclosures and facilitates more efficient capital allocation. Investors are better equipped to assess risk, identify opportunities, and make informed decisions based on standardized and comparable data. IFRS S2, which focuses specifically on climate-related risks and opportunities. Together, these standards create a cohesive structure that integrates sustainability considerations into the financial reporting process. This slide also underscores the strategic importance of linking sustainability to financial performance. Organizations are required to demonstrate how environmental and social factors influence their business models, risk profiles, and long-term prospects. In essence, the ISSB's investor-focused design represents a refined and pragmatic approach to sustainability reporting, one that balances comprehensiveness with relevance and ensures that disclosures serve a clear and measurable purpose. Slide 5. IFRS S1 General Requirements. This slide delves into IFRS S1, the foundational standard governing sustainability-related financial disclosures. It establishes the overarching principles that guide how organizations identify, assess, and communicate sustainability risks and opportunities that may influence their financial performance and position. At its core, IFRS S1 emphasizes materiality, requiring entities to disclose information that could reasonably affect cash flows, access to finance, or cost of capital. This ensures that sustainability reporting is not merely descriptive but directly linked to enterprise value creation. Another critical dimension is decision usefulness. The standard is designed to provide relevant and reliable information to primary users of financial statements, primarily investors, lenders, and creditors, enabling them to make informed resource allocation decisions. This aligns sustainability disclosures with the broader objectives of financial reporting. Equally important is the integration with financial statements. IFRS S1 requires organizations to connect sustainability-related disclosures with traditional financial reporting, thereby presenting a holistic view of performance. This integration enhances transparency and allows stakeholders to understand how sustainability factors influence financial outcomes. From a governance perspective, IFRS S1 encourages organizations to embed sustainability considerations into their strategic planning and risk management processes. It promotes a forward-looking approach, requiring disclosures that reflect not only current impacts but also anticipated future risks and opportunities. In summary, IFRS S1 serves as the cornerstone of the ISSB framework, providing a structured and disciplined approach to sustainability reporting that is both rigorous and aligned with global financial reporting standards. Slide 6. IFRS S2, Climate-Related Disclosures. This slide focuses on IFRS S2, which provides detailed requirements for disclosing climate-related risks and opportunities. It builds upon the foundation established by IFRS S1 and aligns closely with the recommendations of the Task Force on Climate-Related Financial Disclosures. A key aspect of IFRS S2 is the identification of physical and transition risks. Physical risks include acute events such as extreme weather and chronic changes like rising temperatures, while transition risks arise from policy changes, technological advancements, and shifts in market dynamics as economies move toward lower carbon models. The standard also mandates comprehensive disclosure of greenhouse gas (GHG) emissions, categorized into Scope 1, Scope 2, and Scope 3. This ensures that organizations provide a complete view of their climate impact across the entire value chain, enhancing transparency and accountability. From a strategic standpoint, IFRS S2 requires organizations to assess and disclose how climate-related risks and opportunities affect their business models, strategies, and financial planning. This includes scenario analysis and forward-looking assessments, which are critical for understanding resilience under different climate pathways. The emphasis on quantitative metrics and targets further strengthens the robustness of disclosures. Organizations must not only report emissions but also outline their targets and progress toward achieving them. Overall, IFRS S2 represents a comprehensive and forward-looking approach to climate disclosure, enabling investors to evaluate climate-related risks and opportunities with greater clarity and confidence. Slide 7. Integrating Financial Materiality. This slide examines one of the most defining features of the ISSB framework is its explicit integration of financial materiality, the principle that disclosures should focus on information that is material to investors' financial decisions. What is financial materiality? Information is material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions that primary users of general-purpose financial reports make on the basis of those reports. From IFRS S1 ISSB. The slide contrasts this approach with the concept of double materiality, as adopted by European frameworks such as ESRS. While double materiality considers both financial impacts and societal, environmental effects, ISSB maintains a more focused lens on investor-relevant information. Comparison done from a professional perspective, this distinction is critical. By prioritizing financial materiality, ISSB ensures that disclosures remain concise, relevant, and decision-useful for capital market participants. It avoids the complexity and potential dilution of focus that may arise from broader reporting requirements. However, it is important to recognize that financial materiality does not exclude broader sustainability considerations. Instead, it emphasizes those aspects that are most likely to influence cash flows, cost of capital, and long-term value creation. Further, the European Sustainability Reporting Standards (ESRS) developed under the Corporate Sustainability Reporting Directive, are founded on the principle of double materiality. This concept requires organizations to disclose not only how sustainability issues affect their financial performance, financial materiality, but also how their activities impact the environment and society, impact materiality. It ensures a holistic perspective, integrating both inward and outward dimensions of risk and responsibility. Double materiality enhances transparency, accountability, and stakeholder trust, while enabling investors, regulators, and society to evaluate corporate sustainability performance in a comprehensive and balanced manner. This approach also facilitates comparability across jurisdictions, as it aligns sustainability disclosures with established financial reporting principles. It enables investors to integrate sustainability information into their existing analytical frameworks without requiring significant adjustments. In essence, this slide highlights the ISSB's commitment to a disciplined and investor-centric approach, ensuring that sustainability reporting remains aligned with the core objectives of financial decision-making and value assessment. Slide 8. Enterprise value at the core. This slide underscores the central role of enterprise value within the ISSB framework. Sustainability disclosures are required to the extent that they influence an organization's ability to generate value over the short, medium, and long term. The concept of enterprise value extends beyond immediate financial performance to include future cash flows, strategic positioning, and risk resilience. By anchoring sustainability reporting in this concept, ISSB ensures that disclosures are directly relevant to investors and other financial stakeholders. A key element highlighted in this slide is the value chain perspective. Organizations are required to consider not only their internal operations but also upstream and downstream activities that may affect their sustainability profile. This holistic approach enhances the completeness and relevance of disclosures. From a strategic standpoint, this focus encourages organizations to integrate sustainability into their core business strategies. It prompts companies to evaluate how environmental and social factors influence their competitive advantage, operational efficiency, and long-term viability. Furthermore, the emphasis on enterprise value facilitates alignment between sustainability and financial reporting, enabling a more coherent and integrated narrative. It allows stakeholders to understand how sustainability initiatives translate into tangible financial outcomes. In conclusion, this slide highlights the ISSB's emphasis on value creation as the ultimate objective of sustainability reporting, reinforcing the link between responsible business practices and long-term financial success. Slide 9. Interoperability with other frameworks. This slide addresses the critical concept of interoperability, which is essential for reducing the reporting burden on organizations operating across multiple jurisdictions. The ISSB has actively collaborated with other standard-setting bodies to ensure alignment and compatibility with existing frameworks. The interoperability of the International Sustainability Standards Board (ISSB) standards represents a pivotal advancement in the global harmonization of sustainability-related financial disclosures. Designed to serve as a comprehensive global baseline, ISSB standards, particularly IFRS S1, General Requirements, and IFRS S2, Climate-related disclosures, are intentionally structured to align with and integrate existing prominent frameworks, thereby reducing fragmentation and reporting burden for organizations. A key aspect of this interoperability lies in ISSB's close alignment with the Task Force on Climate-related Financial Disclosures, TCFD, whose principles are fully embedded within IFRS S2. This ensures continuity for entities already reporting under TCFD while transitioning to a more formalized global standard. Furthermore, ISSB incorporates industry-based metrics derived from SASB standards, enhancing sector-specific relevance and comparability of disclosures. The ISSB also demonstrates strong compatibility with broader stakeholder-oriented frameworks such as the Global Reporting Initiative (GRI) and regulatory regimes like the European Sustainability Reporting Standards (ESRS) under the Corporate Sustainability Reporting Directive (CSRD). While ISSB focuses primarily on enterprise value and investor needs, GRI and ESRS emphasize impact, materiality and double materiality, respectively. The deliberate coordination among these bodies allows organizations to leverage a building blocks approach, using ISSB as a global baseline and layering additional disclosures to meet jurisdictional or stakeholder-specific requirements. Additionally, ISSB aligns with disclosure platforms such as CDP, enabling efficient data sharing and minimizing duplication. This interconnected ecosystem fosters consistency, comparability, and decision usefulness of sustainability information across capital markets. In essence, the interoperability of ISSB standards enhances global coherence, supports regulatory convergence, and facilitates more transparent, reliable, and efficient sustainability reporting, thereby strengthening investor confidence and advancing sustainable economic decision-making. Slide 10. Climate Scenario Analysis and Transition Plans. This slide focuses on the forward-looking aspects of IFRS S2, particularly climate scenario analysis and transition planning. Organizations are required to assess the resilience of their strategies under different climate scenarios, including those aligned with limiting global warming to 1.5 degrees Celsius under the Paris Agreement. The ISSB has incorporated SASB standards as a key source of guidance for industry-specific metrics. Companies are encouraged to use SASB's 77 industry standards to identify relevant sustainability topics and metrics within the ISSB framework. Further exploring this topic, it is apparent first to understand the role of scenario analysis, which is largely conducted with three steps. A. Identify scenarios, select climate scenarios relevant to the company's business model and geography. B. Assess impacts, evaluate how each scenario affects the company's strategy, business model, and financial position. C. Disclose findings, report the results of scenario analysis, including key assumptions and uncertainties. We take an example related to climate scenario analysis under IFRS S2. The IFRS S2 requires companies to use climate-related scenario analysis to assess the resilience of their strategy under different climate futures, including scenarios consistent with limiting warming to 1.5 degrees Celsius above pre-industrial levels. Now, taking lead from this, what steps are there in transition plans are as follows: A. Current state assessment, baseline emissions, climate risks, and current business model vulnerabilities. B. Target setting, science-based targets aligned with Paris Agreement pathways. C. Action planning, concrete initiatives, capital allocation, and operational changes. D. Progress reporting, annual disclosure of progress against targets and milestones. These elements provide a structured approach for organizations to transition toward more sustainable and low-carbon business models. From a strategic perspective, transition planning is not merely a compliance requirement but a competitive imperative. Organizations that effectively manage their transition are better positioned to capture emerging opportunities and mitigate risks. The emphasis on transparency and accountability ensures that stakeholders can track progress and evaluate the credibility of commitments. This strengthens trust and enhances investor confidence. Overall, this slide highlights the importance of forward-looking disclosures in sustainability reporting, enabling organizations to demonstrate resilience and adaptability in a rapidly changing global environment. Slide 11. The US context, ISSB vs SEC climate rules. This slide provides a comparative perspective between ISSB standards and the regulatory approach adopted by the US Securities and Exchange Commission. While the United States has not formally adopted ISSB standards, there is notable convergence between IFRS S2 and the SEC's climate disclosure framework. A key distinction lies in the treatment of Scope 3 emissions, which ISSB requires, subject to certain relief provisions, whereas the SEC has taken a more conservative stance by excluding mandatory Scope 3 disclosures. This difference reflects varying regulatory priorities and considerations around data reliability and reporting burden. Another critical divergence is in scenario analysis. ISSB mandates climate scenario analysis as a core component of disclosure, enabling organizations to assess resilience under different climate pathways. In contrast, the SEC framework does not explicitly require such forward-looking analysis. While the TCFD alignment largely incorporates full for ISSB IFRS S2 compared to SEC climate rules being partially aligned, and the same is true with their applicability status. From a strategic standpoint, many US-listed companies are voluntarily aligning with ISSB standards to meet global investor expectations and maintain consistency in their reporting practices. This trend underscores the growing influence of ISSB as a global benchmark. Lastly, despite these differences, both frameworks share a common emphasis on financial materiality, ensuring that disclosures remain relevant to investors and capital markets. This alignment facilitates a degree of interoperability, particularly for multinational corporations operating across jurisdictions. In summary, this slide highlights both the convergence and divergence between ISSB and SEC approaches, emphasizing the importance of understanding regional nuances while striving for global consistency in sustainability reporting. Slide 12. ISSB and EU CSRD, Comparative Landscape. This slide examines the relationship between ISSB standards and the European Union's Corporate Sustainability Reporting Directive, CSRD, along with the associated European Sustainability Reporting Standards, ESRS. A fundamental distinction lies in the concept of materiality. While ISSB focuses on financial materiality, ESRS adopts a double materiality approach, requiring organizations to disclose both financial impacts and their effects on society and the environment. This broader scope reflects the EU's policy-driven emphasis on sustainability and stakeholder accountability. Despite this difference, there is significant common ground between the two frameworks. Both emphasize transparency, comparability, and the integration of sustainability into corporate reporting. The European Commission has also committed to ensuring interoperability between ESRS and ISSB standards, reducing duplication and reporting complexity. From a professional perspective, organizations operating in the EU must navigate both frameworks, balancing compliance with CSRD requirements while maintaining alignment with ISSB for global investor communication. This dual alignment presents both challenges and opportunities. While it increases reporting complexity, it also enables organizations to provide a comprehensive and nuanced sustainability narrative that addresses both investor and societal expectations. In essence, this slide highlights the evolving landscape of global sustainability reporting, where regional frameworks coexist with global standards, necessitating strategic alignment and careful implementation by organizations. Slide 13. Biodiversity and nature disclosures. This slide introduces the emerging focus on biodiversity and nature-related disclosures, an area of growing importance in sustainability reporting. The ISSB is actively developing guidance in this domain, building upon the work of the Task Force on Nature-related Financial Disclosures. The recognition of biodiversity loss as a systemic financial risk marks a significant shift in how organizations and investors perceive environmental challenges. Issues such as deforestation, ecosystem degradation, and loss of natural capital can have profound implications for business operations, supply chains, and long-term value creation. From a strategic perspective, incorporating nature-related disclosures enables organizations to better understand and manage dependencies and impacts on natural ecosystems. It also aligns with broader global initiatives aimed at promoting sustainable development and environmental stewardship. The integration of biodiversity considerations into the ISSB framework reflects a forward-looking approach, anticipating future regulatory developments and investor expectations. It underscores the need for organizations to adopt a holistic view of sustainability that extends beyond climate change. For practitioners, this slide highlights the importance of developing robust methodologies and metrics for assessing nature-related risks and opportunities. It also emphasizes the role of governance and strategy in addressing these challenges. In conclusion, biodiversity and nature disclosures represent the next frontier in sustainability reporting, offering new opportunities for organizations to demonstrate leadership and resilience in an increasingly complex environmental landscape. Slide 14, Governance Disclosures, Overview. This slide emphasizes the critical role of governance in sustainability reporting under ISSB standards. Both IFRS S1 and IFRS S2 require organizations to disclose how their governance structures oversee and manage sustainability-related risks and opportunities. Governance disclosures focus on the roles and responsibilities of the board and senior management, ensuring that sustainability is embedded at the highest levels of decision-making. This includes identifying relevant skills, competencies, and oversight mechanisms. From a professional standpoint, strong governance is essential for ensuring the credibility and reliability of disclosures. It demonstrates that sustainability considerations are not merely operational concerns but are integral to strategic direction and risk management. The slide also highlights the importance of transparency in governance processes, enabling stakeholders to understand how decisions are made and how accountability is maintained. This fosters trust and enhances stakeholder confidence. Furthermore, governance disclosures support the integration of sustainability into enterprise-wide risk management frameworks, ensuring that risks are identified, assessed, and managed systematically. In essence, this slide underscores that effective governance is the foundation of robust sustainability reporting, providing the structure and oversight necessary to ensure that disclosures are accurate, consistent, and aligned with organizational objectives. Slide 15, Governance Requirements, Detailed Elements. This slide provides a deeper exploration of governance requirements under ISSB standards, focusing on three key elements. Board oversight involves disclosing how the board monitors and evaluates sustainability-related risks and opportunities. This includes identifying relevant expertise and ensuring that sustainability considerations are integrated into strategic decision-making. The role of management is equally important, as it involves the implementation and execution of sustainability strategies. Organizations must describe how management assesses risks, allocates resources, and monitors performance. The identification of board-level committees responsible for sustainability oversight further enhances transparency. These committees play a critical role in ensuring that sustainability issues receive focused attention and are addressed effectively. From a strategic perspective, these governance requirements promote accountability and alignment across the organization. They ensure that sustainability is not siloed but is integrated into core business functions. Moreover, detailed governance disclosures enable investors to evaluate the effectiveness of oversight mechanisms and the organization's commitment to sustainability. In summary, this slide highlights the importance of structured and transparent governance frameworks in supporting high-quality sustainability reporting and fostering long-term value creation. Slide 16, Strategy Disclosures. This slide focuses on the strategic dimension of sustainability reporting, requiring organizations to disclose how sustainability-related risks and opportunities influence thereby. 1. A key aspect is the assessment of business model impacts, which involves understanding how sustainability factors affect operations, supply chains, and value creation processes. This requires a comprehensive analysis of both risks and opportunities. 2. Organizations must also articulate their strategic responses, including initiatives, investments, and changes to business practices aimed at addressing sustainability challenges. This demonstrates proactive management and long-term planning. 3. Another critical component is the disclosure of financial effects, both current and anticipated. This includes the impact of sustainability factors on revenues, costs, assets, and liabilities, providing a clear link between sustainability and financial performance. From a professional perspective, strategy disclosures enable stakeholders to assess the resilience and adaptability of an organization. They provide insights into how well a company is positioned to navigate evolving sustainability challenges. Ultimately, this slide underscores the importance of integrating sustainability into core strategic decision-making, ensuring that organizations remain competitive and resilient in a rapidly changing global environment. Slide 17. Risk Management Disclosures. This slide highlights the requirements for disclosing risk management processes related to sustainability. Organizations must provide detailed information on how they identify, assess, prioritize, and monitor sustainability-related risks and opportunities. A key emphasis is on the integration of sustainability into enterprise risk management frameworks. This ensures that sustainability risks are treated with the same rigor as financial and operational risks. The disclosure of processes and controls enhances transparency and enables stakeholders to evaluate the robustness of risk management practices. It also supports the identification of potential vulnerabilities and areas for improvement. From a strategic standpoint, effective risk management is essential for maintaining organizational resilience and protecting long-term value. It enables companies to anticipate and respond to emerging challenges, reducing uncertainty and enhancing stability. Furthermore, risk management disclosures contribute to investor confidence, as they demonstrate a proactive and structured approach to managing sustainability risks. In essence, this slide emphasizes that robust risk management is a critical component of sustainability reporting, ensuring that organizations are well equipped to navigate complex and evolving risk landscapes. Slide 18. Metrics and Targets. This slide focuses on the role of metrics and targets in sustainability reporting. ISSB standards require organizations to disclose both cross-industry metrics and industry-specific metrics, ensuring comprehensive and relevant reporting. Cross-industry metrics include key indicators such as greenhouse gas emissions, which are applicable across all sectors. Industry-specific metrics, derived from frameworks like Sustainability Accounting Standards Board, address unique risks and opportunities within specific industries. The disclosure of targets and progress is equally important. Organizations must set measurable objectives and report on their progress, enabling stakeholders to track performance over time. From a professional perspective, metrics and targets provide a quantitative foundation for sustainability reporting, enhancing comparability and accountability. They enable investors to assess performance and evaluate the effectiveness of strategies. Moreover, the emphasis on transparency ensures that organizations are held accountable for their commitments, fostering trust and credibility. In conclusion, this slide highlights the importance of data-driven reporting, which supports informed decision-making and drives continuous improvement in sustainability performance. Slide 19. Emerging Markets and Developing Economies. This slide addresses the challenges and opportunities associated with implementing ISSB standards in emerging markets and developing economies. The ISSB has introduced capacity-building initiatives to support these regions, recognizing that varying levels of resources and expertise may impact adoption. These initiatives include training programs, technical guidance, and educational resources. The concept of proportionality is also important, allowing smaller organizations and those in developing markets to adopt standards gradually. This phased approach reduces the burden of compliance and facilitates smoother implementation. Technical assistance provided by the IFRS Foundation further supports adoption, ensuring that organizations have access to the necessary tools and knowledge. From a strategic perspective, the inclusion of emerging markets is essential for achieving global harmonization in sustainability reporting. It ensures that the benefits of standardized disclosures are realized across all regions. This slide underscores the importance of inclusive and adaptive implementation, enabling organizations worldwide to participate in the evolving sustainability reporting landscape. Slide 20. Global adoption of ISSB standards. This concluding slide highlights the rapid global adoption of ISSB standards since their issuance in 2023. Jurisdictions across Asia, Europe, and the Americas are actively moving toward adoption or alignment. Examples include Australia, the United Kingdom, Japan, and Canada, each of which is integrating ISSB standards into their regulatory frameworks. This widespread adoption reflects the growing recognition of ISSB as a global benchmark for sustainability reporting. From a professional standpoint, this trend signals a shift toward greater standardization and convergence in global reporting practices. Organizations must prepare to align with these standards to remain competitive and meet investor expectations. The slide also highlights the importance of regulatory alignment and collaboration, which are critical for ensuring consistency and reducing fragmentation. Ultimately, this slide reinforces the ISSB's role in shaping the future of corporate reporting, driving transparency, accountability, and long-term value creation. Here, we mark the conclusion of the present discussion. However, it does not signify the end of our exploration into sustainable disclosure frameworks. We will commence Part 2, focusing on ISSB and the future of global sustainability reporting, marks a paradigm shift, embedding sustainability into financial reporting, strengthening investor confidence, and promoting transparency, resilience, and long-term sustainability across global economic systems. We encourage you to remain actively engaged with our channel, participate in the forthcoming sessions, and thoughtfully share these insights across your professional networks, particularly among stakeholders committed to advancing sustainable disclosure practices and fostering responsible, transparent reporting within enterprises. Until then, we extend our sincere regards and look forward to your continued association.